Joining me on the show right now, Sonal Verma, India Chief Economist at Nomura. Sonal, hi, good morning. Good to have you. Expectations from the RBI monetary policy. Do you see a 25 bips rate cut and a change in stance to accommodative, or do you think it's going to be more than that?
So we are expecting a 25 basis point rate cut, which is in line with consensus. And our view is that the forward-looking growth and inflation projections are likely to get revised down. And therefore, we do think that there's a good chance that the stance changes to accommodative from neutral.
Right. Do you think the RBI may keep the stance as neutral in light of the impending election, Sonal? Populist measures and, of course, concerns on fisc?
I think, the stance change is sort of a close call. The neutral stance, of course, keeps the options open for the RBI. But I think in terms of clarity of communication, we do think that an accommodative stance makes more sense, because the risks on the growth side, both because of global as well as the domestic factors, are clearly on the downside. And inflation does look like it's going to stay within the 4% target over the next 12 months. So, therefore, while the neutral keeps the options open, and that could be an option MPC would prefer, we do think that accommodative stance would send a clearer signal.
So, no, markets seem to have already factored in the 25 basis point cuts. Now, if at all the RBI does change its stance to accommodative as well, what would this mean for bond markets, for the currency, equities?
Yeah, you're right. I mean, 25 basis point cut is already expected, but a stance change is not completely expected. So to that extent, that should be a positive surprise. The surprise, of course, could be both on the positive or the negative side. I think one positive surprise is the stance change. A 50 basis point cut would also be a positive surprise. On the other hand, a no change in policy rates would be a big negative surprise. So markets will, of course, react accordingly. But beyond the initial reaction, I think, fundamentals will take over. Fact of the matter is that the underlying growth momentum is quite weak in India. And I think some of those macro factors will come back in terms of, in terms of being the bigger driver for markets in general.
Sonal, some of the lead indicators do point to a slowdown. What's your assessment on growth? What's the bigger picture there? And is there a case for lowering the FY20 GDP forecast?
Yes, we do think that as we enter into FY20, there are two major shocks actually that the economy is dealing with. One is the global slowdown and its spillover into the Indian manufacturing, the exporting sectors. And second, I think still the lagged effects of the tighter financial conditions from last year, and which was exacerbated by what happened in the NBFC space. I think the full impact of that on the consumer side is still playing out. So both these sort of headwinds to growth suggest that growth, at least in the next 6 months or so, will be closer to 6.5%. There might be and there should be some recovery in the second half of FY20, given the monetary policy is easing, but the effect of that will be visible only with a lag. But still, our assessment is that FY20 growth will end up being closer to 6.8%, which is lower than 7% in FY19. And so we do think that the growth projections that the RBI has right now for FY20, which is 7.4, are likely to get downgraded as well.
Headline inflation has really been benign, but the core CPI remains high. Also, there is a risk of El Nino impacting the monsoon. So, what is your assessment on of inflationary expectations?
Our broad assessment is that inflation over the next 12 months will stay below 4%. And I think there are two factors at play. Food inflation led by vegetable and pulses is picking up. But outside of that, actually, food prices do remain contained. If you go back into history, not all bad monsoon years have actually typically resulted in higher food inflation. And the reason primarily is that the income effect, which is weak rural demand, tends to outweigh the impact of a negative supply shock, i.e. lower production. So a weak monsoon is definitely negative for growth, but we are not sure it's necessarily negative for food inflation. Food inflation, therefore, will go up from where we are right now, but still broadly contained, sub 4%. You mentioned core inflation being elevated. Yes, it is elevated, but if we are in a scenario where growth is going to be weak and input cost pressures are generally benign, then even core inflation from 5 plus is going to come down to below 5% within the next 3-4 months. So I think overall, from an inflation perspective, we don't see anything to be too concerned about.
So liquidity concerns are still tight now. Do you think Reserve Bank of India managing? How do you see RBI will manage the liquidity?
Well, I think liquidity conditions are gradually easing, and so it was extremely tight late last year, but I think liquidity conditions have started to ease. And in a rate cutting cycle, policy transmission definitely requires sufficient liquidity, and our view is that the RBI's liquidity stance will be consistent with that. Therefore, that would require, more open market operations, perhaps unsterilized FX intervention if dollar inflows continue, and the bilateral swap lines that they are right now doing. So a combination of all three will continue. We do think that as the RBI lowers rates, and importantly, the reduction in deposit cost does take time. So the transmission to bank lending deposit rates will happen over a period of time. I think the bigger challenge we are facing right now is not so much the liquidity risk, but more the credit risk because of the perception that specific borrowers are perhaps higher risk. But there isn't anything directly that we are expecting the RBI to do at this stage, but more in terms of broad liquidity comfort we do think will be provided.
Right. Sonal, rate transmission may take some more time. Does this mean that rate cuts won't matter much at the ground level?
Well, rate cuts take time, transmission takes time, but that's essentially a reason to front load the cuts. What that means is that the near term one should be prepared to expect further weakness in growth, but the transmission will happen in within the next, I would say, 2 to 4 quarters. So while the next 6 months growth will stay weak, and the Reserve Bank we do think will deliver more cuts, second half of FY20 is when we could start to see more impact on economy in terms of some of the cyclical consumption demand starting to pick up again.
Right. Sonal, the Supreme Court has struck down the RBI Feb 12th circular. What are the implications for the banking system and the economy, you think?
Well, I think, for the banking sector, it does give them some relief. But we'll have to wait and watch, what the new guidelines, the new circular the RBI comes out with. So it does give some near-term comfort to the banking sector, and it is a positive. At the same time, we want to ensure that we also do not put the medium-term financial stability at risk. So I don't think this necessarily changes the near-term macro view. We'll see how it goes depending on the new circular.
Sure. Now, global growth is slowing down. That seems to be the new norm to, that according to the IMF as well as other forecasts. Sonal, global major central banks are now turning dovish. What's the implication of slower global growth for India? What's the scenario there?
Yes, I mean, as compared to other countries in Asia, India is not as open, and therefore the impact of a global slowdown on India is going to be less than some of the other export-oriented economies. But we have seen in the past Indian growth cycles are closely correlated with global growth cycles, and typically the channel of transmission in terms of real economy weakness outweighs any positive impact that could come through to any other channel. So typically the export cycle, slows down. The manufacturing, the industrial sector would tend to see a slowdown. And the strength we have seen in fixed investment growth in India, our suspicion is that that could also start to slow down because of the global moderation, and the weak global demand and the domestic, NBFC issues is essentially the reason why we are a bit more concerned about the growth outlook compared to, I would say, what the Reserve Bank has in its projections right now.
Finally, what is your view on rupee, and where do you think flows could head, and how can that impact the currency?
I mean, the environment is still quite volatile for emerging markets. There's hope that China's stimulus and the Fed pivot is positive for EM, and there's hope that growth is sort of stabilizing. But it's still early days. Our view is that at least in the region here in Asia, next 3 months or so, it's more likely that data is going to still disappoint. But beyond that, we are positive that the stimulus in China and some thawing of the tensions on US-China trade relations will also be positive for growth in Asia in the second half of the year, which could lead to more capital flows coming back. So essentially, more towards the end of 2019, broadly our view is that the pressure will be on currency to appreciate. We're looking at INR closer to 67.5 by the end of 2019.
Sonal, thanks so much for joining us this morning. Always good to get your perspective, and a lot of major macro events globally and in India that we're tracking and trying to understand the implications going forward.